Ladies and gentlemen, welcome to the Motivate Property Podcast. I'm Karli Davies and I will be your host today. If you've been paying attention to the media lately, you'd be forgiven for thinking that getting into the property market is impossible. We've been told prices are too high, deposits are out of reach, and if you didn't buy 5 or 10 years ago, then you've missed the boat. And the result is a lot of people are feeling really disheartened. People who could potentially start, they're feeling like it's impossible and it can't be done. So on today's episode, I am going to be interviewing Corey Jones, and I'm actually really excited because Corey Jones is self-made millionaire, property investment expert, and he has a really refreshing take on this. And I believe it will encourage a lot of you out there today who are keen to get started but are freaking out. We're going to talk about how people are actually getting their deposits together in today's market, what purchasing a property can really look like behind the scenes, and some of the out-of-the-box moves that not everyone is talking about how you can actually get started. So, Corey, you've been through a few cycles of the property market now, and when you look at the commentary we're hearing today, how similar does this feel to other periods that you've kind of seen? And what do you think people tend to forget when fear is being just thrown in their faces?
Yeah, really good question, Katie. I guess firstly, and I think I'll speak to a couple of principles or philosophies that help sort of guide my actions and sort of my mindset. Firstly, for the listeners of this show who've been listening for quite a while, I know that this is a property podcast, and I know sometimes I can get into the weeds of politics, right? And it happens more so as a reaction to what's happening out there. The thing we've got to be mindful of, the world that we live in does not want anyone to succeed. We just got to grasp that fact and accept that that's just the reality, right? And unfortunately, like the propaganda of today, in my mind, is stronger than it's ever been, right? In what, like even just consider today, like how much media shapes our perception.
Oh, 100%.
And that's kind of fucking scary. Right?
Even as someone in the game, like I'm sitting back, have a couple of properties and going, how are we going to get another one? Yeah. Like, will we ever get another home? Like, it's really easy to listen to that and let it dictate your next steps.
Correct. And all I'd say firstly, don't let the media dictate your view of the world. All right. Also, in saying that, if you find yourself caught up in allowing the media to do that, just consider you've probably been brainwashed at some point, right? And it's one of those ones where you've got to consider, like the media, the government, the system, society out there is not designed to create multimillionaires. And fundamentally, what we're trying to do here is help facilitate people breaking out of that.
Yeah.
Just get the world is trying to hold you down at the same time. And that's part of the journey, right? And in fact, there's a part of me that also thinks that that's almost kind of how it has to be in order for you to become the person that can actually break out of the system. All right. So I want to kind of put that there for a second because, in other words, you want to get wealthy, turn off the news, right?
Yeah.
And that's a good way to do it. Having said that, and I also want to get realistic here. Like having said that, like yes, it is tough, and it is tougher than I guess where it was probably 5 years ago, the 5 years before that. Now, the thing we've got to consider here, like all of our market operates in cycles, right? Now, we obviously know every time that there's a boom, there's always going to be a bust, right? Every time there's a bust, there's always a boom, right? And that's a very reductive, I guess, sort of explanation of the fact that the market's going to keep spinning whether you like it or not, right?
Yeah.
And no matter what the market's doing today, it's also not going to last forever. And I know right now, and part of what, I guess what's sort of disrupting clients in one way is the market's booming, and we're the ones who are telling our clients this is not going to last forever. So we've got to make decisions today when the market turns.
Yeah.
But most people out there are running around with their head on fire trying to get anything because they think it's just going to last forever. It's not.
Yeah.
And so, when the times are really good like right now, we've almost got to bring clients back to reality. Yeah. When times are, when we do go through our bust and we go through that doom and gloom, we've also got to get clients, hey, this is not going to last forever and it's going to bounce back, right? And so there is an element of us having to hold a certain line to make sure that our clients' mindsets are also aligned with what they're trying to achieve, right? And that's why I think mindset's probably one of the most important things when it comes to wealth. Now, with all that said, and like I said, I'm just providing a couple of little philosophies here that will hopefully help provide some stuff. But like, we've got to get in the world. We've got multiple markets here, right? So we've got the finance market.
Mm-hmm.
The finance market fundamentally run by, the RBA dictating the interest rate. Then you've got all the banks. Like, they're working, and really fundamentally what they're really trying to do is actually prevent big booms and prevent big busts.
Yeah.
Right. So they're essentially pulling levers and facilitating environments where, they're trying not to cause bigger booms and bigger busts. So they're always going to be a lot more conservative. Now, in saying that, since 2017, the Royal Commission, like, the banking and lending system is tighter than it's ever been. And I'm not talking about how much money you can borrow. I'm talking about, like, just physically trying to get a dollar from the bank.
Yeah.
Like, the amount of steps you need to go through just to get one freaking dollar.
There's a lot more red tape.
Way more red tape. Now, granted, this is a reaction from the GFC.
Yeah.
Right. And you remember the GFC in the US, they've got completely different laws over there. And fundamentally, the way it sort of happened over there is in the subprime mortgage issue was you have a lot of, let's just say, funds out there purchasing, let's just say, some pretty shitty investments and mortgages, right? What happens in America, and really what kicked off the GFC, is the fact that if you don't want that house anymore, as an American citizen, you can leave the keys in the letterbox and walk away. The house is no longer yours.
Yeah.
Right? In Australia, you're on a certificate of title. Mm-hmm. That house is yours until you sell it, right? And you're legally bound to that house, right? Yeah. So that in itself, like, just that one mechanic that allows Americans to give their keys away and walk away, and they're now reduced, they removed all the risk of owning that house. That's what actually kicked off the GFC. Mm. Now, again, in Australia, that same mechanic can't necessarily happen with the way property works. But again, the banks still overcorrected as a reaction to what they did. Mm. I think they overcorrected way too hard, right? In a lot of ways.
We've also had, all the first home buyer grant or schemes that have come and just inflated things even further in, the last, 6 months?
And then COVID, because, I mean, even like, in my mind, COVID kind of screwed the pooch in a way.
Yeah.
Right. And I say that not because it changed the market. What it did was it once again got the government to start reacting, not responding. Mm. And I'll explain this in a sec, right? So, you got the finance world. It's harder to get money than it's ever been. Right. Then obviously comes along COVID. Now, when COVID happened, I actually remember a couple of our clients calling me in 2020 being like, hey man, we got to cancel this, we got to sell everything, like the world's going to crash, like it's just going to turn to shit. And, there was a few kind of bits of advice I sort of provided at the time. And I said to clients, guys, hold, right? Let's just see what happens, where we're going, right?
Yeah.
Obviously the market's practically doubled since then in the last 5 years. Now, again, speaking to COVID, like what kind of changed the game and made things harder again was the way that the government reacted and not respond, right? So again, issue happens, the government's just run around like the head on fire thinking, shit, we need to do this, and this, without really thinking about the long-term consequences of those policies, implemented as Band-Aid solutions. The market is cooked today because of that.
Oh, 100%.
Right? And when I say it's cooked, like, we don't have enough houses. Yeah. We've got immigration through the roof. I mean, 493,000 people in the last 12 months have come into the country. We're building less than 200,000 homes for those people. So we're not building enough houses.
Yeah.
Our construction industry's cooked because we don't have enough skilled workers. Our supply chains are all disrupted because of the COVID, and obviously a lot of the war happening around the world. And then to top it all off, you've got, and I'll use the word draconian, you've got these old school, local councils who know that we need to increase density, but just don't want to subdivide their area because it's going to overpopulate and ruin their area. So we don't have enough land to develop in one of the most land-rich countries in the world.
Yeah.
So there is a multiple stage issue across the board with the industry. And again, I've got a philosophy. There's no such thing as bad team, only bad leaders. From one of my heroes, Jocko. Mm-hmm. Right? Now, really what he's saying is the leadership fundamentally is the biggest catalyst of everything.
Oh, definitely.
And if the government or the powers that be are going to react and provide Band-Aid solutions, for example, the home builder grants,
Yeah.
Right. And again, in theory, it makes sense, right? Like COVID happens. We need to keep the construction industry moving because we don't have enough, we need to make sure these people still have jobs. We're going to pause mortgages. But then throwing the $10,000, $20,000, and then the $45,000 for the first home buyers, like that just completely overcooked the market. Builders were essentially overselling their book, knowing they don't have the trades and the land available to do it.
Yeah.
And obviously created this massive backlog, and we're still feeling the effects.
And I think, like, obviously as investors, you're like, this is great. Like, supply and demand, the demand's there. There's no supply. My property is just going to keep increasing. But I suppose as someone who isn't in the market, and is on the sidelines going like, I really want to get in the market. I really want to get started. Like, this does look like the impossible challenge. Like, what would you say to them, like, about how do they put that aside and actually get started?
Yeah. So I guess the point is it is harder today than it was 5 years ago.
Yeah.
We have to accept that firstly and just get like, it is what it is.
Yeah.
And accept it. And the like with most of what we're doing here, and particularly when it comes to mindset, one of my favorite, and this is from Buddhism, right? The more you resist, the more you suffer. The more you resist that the market sucks, the longer it's going to take you to get in and do something about it.
Yeah.
The more you're going to end up suffering long term.
Yeah.
A part of the mindset required is just surrender, accept it. And it is what it is. Now, in saying that, what can we do practically? The market hasn't actually changed.
Yeah.
Right? So as hard as it is to get in, it's still the exact same mechanics that are driving it. It's still a function of population versus houses. Now, yes, where people are moving to, where the populations are migrating to, infrastructure and employment, and there's a lot of other things that go into where, but fundamentally it comes back down to supply and demand.
Just quickly, before we get into the mechanics of it, mindset has been a big part of your success.
Yep.
And I think, like, obviously Motivate, part of the reason we're called Motivate is to help motivate clients, motivate, people listening that they can do this, that it is possible. Where do you feel people trip up in their mindset? Because obviously you've seen hundreds of clients and, you often have similar narratives come through. Where do you feel people trip up in, like, what's stopping people from starting a lot of the time?
Yeah. So, and look, there's a number of reasons, right? Like, if we think about just the average person out there, not even talking about our clients or even our listeners for that matter, just the average person, most people don't understand how any of this stuff works, right? Most people, you walk down the street, hey, what's the benefit of owning an investment property? They're going to walk past, well, I've got no idea, and keep walking, right?
Yeah.
So, and again, this is more of a function of, like I was saying before, society. Like, school isn't designed to create millionaires.
It doesn't teach us any of this stuff.
Correct, right?
Yeah.
It's designed to create worker bees, factory workers, people who can comply with instructions. And granted, we need that in a sustainable workforce. So there is an argument that that's
required.
It's required. Yeah. But having said that, in my mind, if you invest correctly, work can be a choice. And that's ultimately the desired goal for our clients, right? But at the end of the day, the first thing I would say for the most part, the bulk of it is just unaware. They just have no idea. And the guys who think that they do and aren't doing it very well, they might have an idea, but they're just doing it wrong because what they think they're doing versus what they should be doing, two different things, right? And that's where your cash flow and growth and all that sort of stuff can play into it. So
strategy comes in.
Being unaware is probably the biggest thing. Then we've got to consider, if we just narrowed down, the people we're talking to, let's just say property investors. So again, not our clients, not our listeners, just purely people who are investing in property. There's around 2 million in the country. Last time I looked at the stats, 94% of property investors own one property.
Yeah.
So that's like saying that 94% of the people who are doing this aren't doing it in a way where they're actually really succeeding. And not to say that, you've got one property, you're not doing good, sure, but you're not going to be replacing your income with one property. You're not going to be, providing your kids, any future they want with one property.
Yeah.
And I guess a very rough rule of thumb, one property brings in around sort of 20 to 25 grand a year. So you got one property. Sure, you may have supplemented your income and wealth by about 25 grand a year, but that's 25 grand a year. Most people need 100 grand a year.
Yeah.
So the average person's really going to need around that sort of 4+ in order to sustainably get themselves through retirement. However, when you look at how many people have got 4 or more, it's less than 1%.
Yeah.
So even the guys who are investing in property, majority of them don't have the right strategy. They're not buying the wrong they're not buying the right properties. They're not, they don't understand what they're actually trying to get out of it. They just think, oh, I need to own a rental to get wealthy. All right.
Yeah.
Then we look at, say, for example, the guys that we meet. And again, there's a number of things that I would say would hold clients back, or reasons why they wouldn't go ahead from a mindset perspective. A lot of them don't really understand why. Right now, for me, motivate, and the word motivate isn't about blowing smoke up someone's ass and making them do something. Motivate is really understanding what is the why.
Yeah.
Are we running towards something? Are we running away from something?
Yeah.
Because the why for me is like that's the spark that lights the fire.
Mm.
You still need the fuel.
Of course.
All right. All it is just the initial spark.
Yeah.
Now from that point, the amount of clients that we've got come to us and they want to do this because their friends are doing it, terrible why.
Yeah.
Right. Because as soon as it gets,
well, they quickly find out their why when they have a chat with us and
right.
Go through things. But yeah.
Yeah, but when they come to us, if you're doing it for the wrong reason, and when I say the wrong reason, it's like your nervous system is simply not going to do the work that's required if you've got some really flimsy why. And for some people, getting rich is a very flimsy why.
Yeah.
I want to have this car, and when it's very ego driven, it's very flimsy. And it's more so, again, when the times get tough, like, are you going to do the work that's required? You're not. Because it's for this superficial comparison, egotistical, kind of thing, right? And that, from a mindset perspective, I would say probably the main reasons is what holds people back. But I guess to your earlier point, right? Like, or to your earlier question, like as interest rates rise, you need more money to get in.
Yeah.
As property values continue rising, and when I say continue rising, yes, the market's grown, but also the government and the market forces have not facilitated an environment where we've got a stable market. We've got a rocketing market, and that's a problem, right? And even as someone who, and to be clear, I'm making millions of dollars right now, the market's booming for our clients.
Yeah.
I don't think this is a good thing.
Yeah.
And I'll be the first to admit that. It's like, this is not good long-term for us as a society. And again, if we fast forward, if we keep doing this 15, 20 years down the track, we're going to look like most third world countries where you've got, families who can't afford to buy the local real estate because they've got incomes that are nothing as compared to it. Everyone's going to be renting. Everyone's going to be living with, 2 or 3 generations in a house, like most of Europe, most of Asia, right? Yeah. And so this is where I think, for me personally, I think we need to have a balanced market. But as asset values get higher, as interest rates get higher, the amount of money you need as a down payment, which is the biggest barrier for people, is just getting higher and higher.
Yeah.
When I got in, you could get into the market with, 10, 15 grand, 20 grand.
Yeah.
Now you need 50, 60 grand.
Yeah.
And again, it's that goalpost of saying, say, 10 years ago, getting in for 15 grand, today you need 50,000.
Yeah.
It's that gap that's creating the most amount of fear. And fundamentally, that's actually what's pushing most people away from this.
And I think even talking about that, like the goalpost is shifting so dramatically, even month to month at the moment, is that the market's moving so quickly that, someone's got a decent deposit, goes to, go put a offer in on a place and misses out because someone's got more, or, the benchmark's moved again. Correct. And so that kind of like leads into really nicely that next question of like the mechanics. So, for someone who's wanting to get started, obviously the deposit is a big part of that. And so I suppose the question is like, with the market moving the way it is at the moment, how does, say, someone who's got a bit of a nest egg going on actually keep up, as opposed to like their number essentially going backwards in value? What would your recommendation be?
Yeah, very good question. So again, I'm going to come back to a philosophy, and I was speaking to this in a training session yesterday with the team. At all times, you want to have your money doing one of two things, always. It's either expanding your portfolio in some way, or it's reducing debt and reducing risk. Right. So let's say, for example, we've got the average person here, whether they're in the market or not. Let's say they're not in the market, but they've got, say, 50K. Right. The question is, where is that 50K best spent? Is it used to expand, or is it used to reduce risk? Now, if you've not got a house, you've got no debt, there's no real risk to be reducing. All right. So in other words, like I would be tunnel vision on expanding my portfolio and putting that money to work somewhere. Now, the hard part is we're talking about property being that suitable. And I still believe, hand on my heart, today in 2026, even though the Perth median price is around $1 million and it will punch well over $1 million this year, I still believe that Australian residential property is the best vehicle for anyone building wealth in the world, not just the country, in the world, because our properties perform so freaking well over here. Now, does that mean that getting the property is the first step for everybody? No, it's not. All right. If someone had, say, let's just say 30 grand, and this is how I started, I put that 30 grand into the stock market.
Yeah.
All right. And I was actually actively investing in the stock market and, just putting money in an ETF back in the day. When I went to the Middle East, came back, that's when I basically pulled it all out and used that to go and dump in a property. But again, it was because I was actively investing that money beforehand. That's what allowed it to grow even further than what I could save. And, I had the ability to go and put down a 20% deposit.
Yeah.
Which, again, not normal for a first-time buyer.
And even in this kind of environment, there's just so many opportunities to be able to do that. It's so accessible to invest in shares now than it's ever been.
Yeah.
And, even with an ETF, like they're pretty safe. Like you're dealing with the top 100 companies and they're not all going to fold all at once.
Correct.
So I feel like even now I know for some people even that feels risky and that feels like, well, I've saved this amount.
Yeah.
Like if I go and put that in shares now, like am I just gambling it away?
Exactly.
Yeah.
Yeah. And I get that.
Yeah.
But I think like being open, because look, here's the thing too. There are 1,000 ways to get wealthy, and property I think is one of the best vehicles. I think it's the best vehicle, particularly for people starting out with. But at the end of the day, like that's not going to be everyone's future.
Yeah.
Either, because again, for a lot of our clients, even, they might go and buy 3 or 4 houses in the first few years. And we might say, hey, look, that's all you need. Now the rest is going to be in shares, gold, and all these other asset classes. And that's where your cash flow is going to come from and, vice versa. But I guess the thing to keep in context is, like the first house is always going to be the hardest. And it's always going to be the hardest, and for good reason, because like I said before, there is an argument to be made that for you to be from where you are today to where you want to get to, you've actually got to evolve as a human. It's not just going to happen just with numbers on a screen.
Yeah. Like
you've got to become a better person, right? In a lot of ways, because it's not just about building the wealth. It's also, are you the person that can keep that wealth?
And hold it, yeah.
Exactly, right?
Yeah.
And that's where I think there is something to be said about the sacrifice required to get in, and that sacrifice is actually needed for you to be who you are. All right? With that said, though, right? Like shares are obviously one that's low-hanging fruit. There's a few different alternative investments like that you can get in with basically dollars, and you can build up, certain amounts of capital. But at the same time, like the other thing we need to keep in context is that there are a few ways to get into property that are outside the norm. But we've also got to keep in context, like what is Australian property, all right? And what I mean when I say that, we live in a world right now in Australia, or in Perth for that matter, where your first home buyer is buying a 200 square meter 4x2.
Mm-hmm.
Largest homes in the world.
Yeah.
Right? Now, I'm not saying Australia has the largest home. What I'm saying is Australian first home buyers are buying some of the largest homes as first home buyers in the world.
Yeah.
So when we've got immigrants coming here from Africa, Asia, the Middle East, they come here and rent an apartment, let's say, and that apartment's bigger than anything we've ever lived in.
Yeah.
There's a gap there, right? And really what I'm saying is, our expectations, I think, are also partly some of the problem to play when it comes to, how soon we can get in and what we're buying.
Oh, 100%. Like everyone wants the, house with the yard to the kids, when they eventually have kids, can have room to play, right, and all of that kind of stuff. So 100%, like that is pushing things even more so. Yeah. And like you said, even before, like, local councils not wanting to subdivide, and where there's possibilities to do so. And, there's so many opportunities for more properties to become available, yet we're still in this kind of gridlock at the moment.
Yeah. I was trying to clear about this before because, like I said, we're used to houses being the norm. I can foresee if we keep going down this road, like in 20 years' time, apartments are going to be the norm.
Yeah.
Like the only thing you'll be able to buy is apartments.
Yeah.
And then, you think about going down the freeways, north and south, right? Like all along the freeway is just going to be high-rise apartments. Every exit, there's going to be apartments on every corner.
Yeah.
And our clients who own land are so much wealthier for that.
Yeah.
You know what I mean? Because they're buying land, right?
Yeah.
And so again, it's like there's also an element of like our market also is going to be evolving, and it's going to have to adapt to this. And our expectations are going to have to start changing, in terms of like, what does it actually mean to buy our first, like, what does it mean to get into it and build a property portfolio? Because you look at, say, most of Southeast Asia, you look at a lot of Europe, you look at a lot of these older, mature cities, you're not buying a house in London. You're not buying a block of land in New York. Like, you're just not. You're buying an apartment.
Yeah.
And again, whether we like it or not, that's the direction we're heading.
Well, even as well, you can see how the property prices for even units have, gone up as the demands, for more affordable options has, how that's impacted, their prices even in the last 12 months. Like they've increased dramatically. It will be really interesting to see how things do change, if they change. Well, they will change, but how?
Yeah.
And like you said, what mechanics the government actually pulls to potentially change things or continue this way. So as far as like that deposit, so obviously like investing, is there any other kind of like creative ways you've seen clients like maybe accelerate their deposit? Obviously side hustles, things like that
for sure.
All different ways. But is there anything else that you kind of like, oh, I love this idea?
Yeah, for sure. So I guess there's two things there's two I guess sort of worlds here that can help. World number one is you and your position, right? The world number two is like the strategy of actually buying, all right? And there's two, like I said, there's two worlds. So when it comes to you and your position, like firstly, yes, the more money you earn, the faster your deposit's going to come, plain and simple. But I also want to highlight it's not just about what you earn. It's about what you keep.
Yeah.
Because if you're living, let's just say you're earning $100,000 a year and you're spending $995,000 of that, guess what? You're not going to be saving a bunch of a deposit, right? And so like one thing, it's not just focus on your income, it's also focus on your expenses and make sure that there is a gap there. And if there's no gap, you might need to just review your situation and make a gap. Now, what that might look like, and to be fair, guys, when I first bought my first house, probably shouldn't say this, but I'm going to say it anyway. There were some nights where I was sleeping under my desk.
Yeah.
I was living off meagering.
Yeah.
And guess what? That's what allowed me to get in my first house.
And you know what? I actually think that needs to be discussed as well.
Yeah.
Is because, I think it's really easy to go, I want a house, but are people actually willing to make the sacrifices to get into the door? Because once you're in, like, even personally, my husband and I, there are definitely times where we're cash poor.
Yeah.
Like, but we had property.
Yeah.
Like, and, we chose to go, no, we know long term this is going to put us ahead. But, like week to week, it was a struggle. Like, and you would have to make those decisions of like, I'm not buying the newest XYZ. I'm not subscribing to a not Spotify. Spotify was one back when we first bought. Like now, obviously, there's so many more subscriptions you can
100%.
subscribe to. Even just subscriptions, like have a look at your subscriptions. Like, sometimes there's ones you don't even realize you've still got.
Yeah.
But like all of those things, Afterpay, like there's so many, things that I suppose, for lack of a better word, this generation is exposed to that was never a thing. Like even eating out, like the ease and the access of eating out these days. Like, you look a couple of generations ago, the only time they were eating out was for like a huge event, like a big celebration, someone's birthday or something like that. Whereas now it's like every week or, so there is something to be said as well for, what are you willing to actually sacrifice?
100%.
What are you willing to actually kind of choose to get ahead?
Yeah. And to that, we all know in theory, that our budget's elastic when it comes to earning more money. Your budget starts expanding. Most people don't realize that it's also elastic the other way. It's just a lot harder and it's painful.
Yeah.
I've been broke 3 separate times in my life. Yep. When I say broke, I'm talking like my car's just been declined getting groceries and I'm not eating tonight.
Yeah.
Kind of broke.
Yeah.
You know what I mean? So like there's you can reduce your budget, you can reduce your lifestyle. It just comes with pain.
Oh, yeah.
Whereas when you're expanding your lifestyle, it's very pleasureful, right? And it's a lot of fun, right? Buying more shit and doing more things, and it's all well and good.
But also then it's also, as you expand, it's, where do you stop as well? Like sometimes it's easy to just keep going.
Yeah.
And even, like we moved suburbs these, the last couple of years and to a more, well-off area. And it's amazing how even just moving suburb, even though like our rent isn't necessarily any more than we're paying for our mortgage, like just being around certain people and certain clothes and certain cars, and it's really easy to just really quickly go, I'm going to have a coffee every day because I'm chatting with my friends in the morning after school drop off, and very quickly that's $40 that week, like, and then you got a partner and you're both doing that, like that's $80 a week.
That's right.
That quickly adds up.
Yeah. And so when you couple that with then going out and doing your side hustles and making more money, like that's where you can get that gap between your expenses and your income to really start supercharging. And really, like, saving that first deposit is always gonna be the hardest. But that's I guess kind of the main sort of strategy when it comes to you and getting yourself squared away.
Yeah.
When it comes to buying, there are a couple of different strategies here. So firstly, obviously, for the first time buyer, getting the grants is great, right? I mean, because they're providing $10,000 in WA. There's like 15 and 20 other states. But there's a lump sum you get at settlement to reduce the amount of money required as a down payment. All right, then you don't pay stamp duty. So there's another 5 to 10 grand, right? Yeah. So you're getting around sort of that 15, 20 grand from the government to get in, which is
huge.
When I got in, we didn't have that. All right. So that's also something that's easier today than wasn't there. However, you still need your 30, 40, 50 grand, right? So the amount of money required is still a lot. So the grants are one thing. What a lot of people don't realize is there's actually schemes out there, like really designed, particularly for lower income earners, to still get into property, right? Yeah. It's called shared equity. I'm not sure if you've heard it before, but basically, there is a scheme where you can essentially, under the shared equity scheme, you can go and purchase, let's say this is the house you really want, all right? You can purchase it, but only pay for, say, 65%. The government pays the remaining 35%. Yeah. When you sell it, you get 65% of the equity, the government gets 35%.
I think this is a really great scheme.
Well, it's like, if I was in that position, I'd be doing it.
Oh, 100%. Especially if you're like not earning huge amounts and you fall into their criteria. Like, it's a great way to get your foot in the door, get that kind of capital growth and still walk away with, a win. Like, whether you obviously hold on to it for however long till you refinance or whatever else, but it's a great opportunity.
Yeah. And it doesn't mean you have to do that forever.
No.
If that allows you, because here's the thing, like once you get into the market, the hardest part is done.
100%.
And then from there, it's just simply a game of now we're just playing Monopoly from this point onwards.
Yeah, and I think that's the thing that a lot of first-time investors don't necessarily understand, or they get too emotionally caught up in the, I want it to be my home, or I want it to be X, Y, Z. But the reality is you just need to get in.
Yes.
And however that happens, like, it doesn't need to be fancy. It doesn't It doesn't need to be, bells and whistles, but just getting in whatever way you can. And so what are some, like, obviously you've just spoken about that. What are some other kind of ways that, first-time investors can get in that maybe they're not aware of, or kind of, isn't maybe at the forefront of their minds?
Yeah. So shared equity, like I said, is one. Another really good one is like using a guarantor. That could also work. So this is bank of mum and dad, right? Now, again, I wouldn't necessarily say that your parents going the traditional guarantor of securing your new house you want to buy with their home is the best way. There's a slightly different finance strategy that keeps their home safe, but basically leaning on your parents. Now, when I say that, it doesn't mean your parents have to borrow any money.
Yeah.
It's
I think this is the biggest thing people get confused with.
right. Yeah. So when it comes to your parents, it's more a function of they're essentially lending equity to you to go and do it. But you've still got to pay all those costs, and your property ends up paying it back for them.
Yeah.
Right. So again, it's just a temporary mechanism. And really what it looks like is, let's just say, for example, we've done this a shitload of times where, the parents are willing to lend the client, son or daughter like 200 grand. That 200 grand is a very big, healthy deposit on a property.
Yeah.
Within 3 or 4 years, the property's already made 200 grand.
Yeah.
So we go and borrow 200 grand from the new house and we go and clear the mum and dad's debt.
Yeah.
So that's a very similar one we would do, quite often, right?
But I think in people's minds, though, it's like we're going to mum and dad and they're giving us this big wad of cash. And really, at the end of the day, it's all just paperwork.
It's numbers on a screen.
And I think I know that like we were really fortunate to have a guarantor for us. A family member was happy to do that. But like when I asked my mum, like her journey's been very different as a single mum and whatnot. And, even though she had huge amount of equity, she was like because the risk, the fear of the risk.
Yep.
But in reality, it's pretty safe if you do it well.
Well, yeah, I mean, it all comes back down to finance structure. Because like I said, the way that your traditional guarantor works is they get mum and dad's title, they get your house and your title, and they secure the mortgage together, and then the title's together.
Yeah.
So you miss repayments, they're going to start foreclosing on your mum's house, right? Which that's bad news all day long. We would never want to facilitate anything like that.
No.
And that's also under the assumption that our client's going to be a rat bag.
Yeah.
Right. So that's going to we're going to assume that your son or daughter is going to borrow this money and they're going to go piss it up a wall. Here's why your money's still safe, right? Because of the way that we sort of do it. But like guarantor is a legitimate option.
Yeah.
Now, this is a bit of a tricky one. This isn't going to be suitable for a lot of the first-time investors, just purely from a risk perspective, but this might be suitable for some. There are strategies out there where if you were able to borrow a deposit from somewhere, all right? Now, I'm not going to say a lender or a credit card or personal loan. Wouldn't recommend those because those terms and conditions are heinous. But let's just say, for example, you were able to borrow a temporary facility from a parent. Let's just say it's 50 grand as a deposit. Yeah. If we can do some really good work and find an under market value property and purchase and get a high bank valuation, by the time that you're ready to sell and actually transact on that property, you don't need the full deposit anymore because there's already equity built in the home from what you were able to negotiate versus the realistic market. So again, you need a lot of experience, a lot of guidance, and a lot of professional help to actually pull that off, but that could work.
Yeah. That's essentially what happens when you've got a new build as well, is, like that initial kind of like as a, from buying the actual land to when it's actually starts being built, often there's a jump in the equity as well. And then you're able to then
buy second, buy third.
Buy second and third before you've even built.
Correct. And that's a similar mechanism. Exactly. So that's a similar sort of situation, but this is more so even for the first time. You can there are ways you can do that, So that could be an option. Keep in mind, right? Like the biggest barrier, like I'm talking the actual barrier for most people is the deposit.
Yeah.
All right, because most people have enough income. Most people have an income, they can borrow. Sure, it might not be the desired amount of money you want to get for the home you want, but you've got enough income to borrow.
Yeah.
It is coming up with the deposits the hardest part. Yeah. So the thing we've also got to keep in context, the day is not going to come when no one can buy a house.
Yeah, because the banks want to keep borrowing because they keep making money.
Exactly. Right. Now, we've got to keep in context. The Australian banks are, unfortunately, off our back, the most profitable corporations on the planet. Right? Our banks in Australia are more profitable than most other banks around the world.
Wild. They
make the majority of their income from mortgages. So the reality is there is way too much invested from a let's just say the industry is way too heavily invested in people being able to do this.
Yeah.
The government, I'm not going to pinpoint any particular politician, but a lot of the politicians are also implementing these strategies for themselves, right? So they're not going to go and implement things that are going to negatively impact this either.
Yeah.
So the thing we've got to keep in context as well, and this is why I'm hopeful. Like the day's not going to come when first home buyers can't buy houses.
Yeah.
All right, it's just not. They're just going to start creating different
products.
Well, exactly. So, like the shared equity is a good example, but things like, for example, 40-year home loans is going to become normal pretty soon.
Yeah.
And all that's simply a case of, instead of back in the day it was 15 years, so right now there are multiple banks offering 40. Yeah. By the time that our kids, potentially grandkids, it might be 50. You go to most places around Southeast Asia. I mean, this happens in Bali, it happens in Thailand, it happens in the Philippines. You got 990 home loans.
Yeah.
That's normal because you got median wage, median price of houses. The only way to make that work is to give an intergenerational home loan. Granddad borrows it, grandson pays it off. That will become the standard here. And again, when those schemes happen, the further we kick down the mortgage time frame, the less you're going to need to have to actually get into the market. All right, and that's coming. Now, the other part of that argument is, hang on a second, Corey, but then we're paying over 40 years, not 30, therefore we're going to pay a lot more in interest long term. Yes, absolutely. And I would still refinance every single one of my houses today to 50 years if I could, because it means my repayments are lower, the house is more positive cash flow, they're going to become a lot more positive cash flow a lot quicker, and I can buy more houses. Yeah. So the time frame as an investor, in my mind, is one of the most irrelevant things you can possibly think of, because I'm not going to be paying this house off in 30, 40 years. My tenant's going to pay it off in around sort of 15, 16 for me. All right. So the time frame's irrelevant.
Yeah.
But all it does, it's just another mechanism from the banks to lower the bar to get more people in. This will come, particularly if the market gets too tight. Because like I said before, and the reason why I start off with the banks at the beginning, because like I said, we're talking about basically, the government in one hand, what the banking industry is doing, what the building industry is doing, what the real estate industry is doing. Yes, there is they kind of work hand in hand in some cases, but they're three different worlds.
Yeah.
And so one of the things that the banks are often doing, and this is why banks are always offering different products and different, different requirements and different mortgages and changing the goalpost constantly, is because they have to have a certain amount of risk on their book. So, in their portfolio, and this is like all of the loans, let's say in a pie chart, they want to have X amount of first home buyers. All right. They want to have X amount of, safe investors, 50% loan value ratios. They want to have a small portion of really, really high risk. They want to have a portion of business, a portion of this, portion of that. And it's a mechanism for them to make sure that they're diversified.
Yeah.
But it's also a mechanism to know that no matter what the market's doing, there's always an incentive for the banks to be able to write those kinds of loans to somebody.
Yeah.
It's just a matter of finding the right bank and making sure they got the right product, right?
Yeah.
So I don't think the day's going to come where it's just all going to stop.
Yeah.
It's just that the market and the goalposts will just adapt and change based on what we need. All right. So
I had a really interesting conversation with a property investor recently who's got, a reasonable portfolio. And I think even talking about kind of looking at different options, I think that, and talking about what the banks will and won't lend, I think something that he had a conversation we chatted about, which I found really interesting, was like not taking no for an answer from the banks. And so I think that's where, I suppose, even, our team our finance team are really great at working with clients to find the right product to suit them. And I think it was actually really refreshing because, I've worked with a great broker, with our properties to get us, our investment properties and whatnot. But he was like, well, if your broker's saying no and you know it's possible, you just need to get them to push back on the bank. And, if you're doing the numbers and you're going, this will work, and, your broker's going, this should work, and the bank's saying no, well, then you're not going to the right bank.
Yeah.
And I just was like, okay, yeah, that's so true. And I suppose even for some first time, investors, property purchasers, it's also maybe, speaking to the right brokers as well, and who can actually understand your situation fully and actually go, okay, this is what's possible.
Yeah. Because you're really what we're sort of talking about here is like the loan to value ratio fundamentally, right? Because if, let's say you approach a bank and for whatever reason they say, yep, we want an 80% loan to value ratio, that means they want to borrow 80%. They want you to have 20%, right? And that's just the line that they've drawn. For all the first home buyers, you can put in 10% deposits. There's a few banks
low end.
We can do 5. There's a couple you can do 2. There's some you can do 1. There's a couple of the higher, and keep in mind the high LVR the worse the terms are, the higher rates are, the more
But
risk
again,
you are.
like getting in is the
Exactly.
there's no reason you can't refinance, in a couple of years' time when you've got some runs on the board.
100%.
Like,
And at the same time, it's also like I'm not particularly fearful of the interest rate.
Yeah.
Especially in markets like right now. Again, let's say I'm going to pay a 7% interest rate.
Yeah.
And that's on the assumption that I'm going to be the one 100% paying for the property.
Yeah.
If the market's grown at 10%, I've still made 3%.
Yeah.
But that doesn't include the fact I'm going to put a tenant in that house, and that tenant's going to be absorbing.
Too, yeah.
Correct. He's going to be absorbing most of that 7%.
Yeah.
So, and then that gap for me is what's allowing me to put wealth and go to the next. So, like there are lenders that'll do a 2% deposit, 1% deposit. We only need 5-10 grand. We don't do a lot of them just because we would rather work with a client a little bit longer, a few more weeks, and just put a bit more away and get like a much better product.
Oh, 100%.
But again, we're going to see more and more banks do this.
Yeah.
I don't know if you remember back in the day, KD, this is probably...
Before my time.
No, this was about 10 years ago, where there would be builders out there, and there would be an ad on the radio. It's like, you can buy a house for $1 down. Do you remember those?
Yeah, vaguely.
Vaguely, yeah. So what most people don't realize is, like what they're actually doing, right? And when people sort of get this, and this is what I'm saying, like it sounds really good, but when you look at behind the scenes,
really. Yeah.
there's better ways to do it. So what they would essentially do is they would say to a client, no, you know what? We can get you in the market for $1.
Yeah.
Or $1,000 or whatever, $5, whatever it was. You pay the builder that $1. What the builder then does is they give you a personal loan of $30,000 or $40,000.
Whatever your deposit is.
Whatever the deposit is, right? And it's a personal loan either from the builder or they'll help facilitate it and lend through their channel. The interest rate, you're going to be talking 10 plus. So it's like taking out like a freaking car loan.
Yeah.
But now you've got that money sitting in your account for 3 months. It's now deemed genuine savings, and that therefore can be used as a deposit on a property.
Yeah.
And then obviously, once you purchase the property, you've now got those 2 loans. You borrowed 100% of the property because one component in the deposit was at a higher rate. The rest of it was from bank. You pay the expensive one off first, and then you have your house and you keep walking to the sun. Like that's all sounds good on face value. But if you're someone who's struggling to even just save a deposit and then you're going to take out a personal loan at an extortionate interest rate and then take out a mortgage on top. Well, look, let's just say that you're sort of setting yourself up for failure pretty quick.
Yeah.
In other words, like I would rather work with a client for another 3 or 4 weeks, have them on a really good savings plan, putting some real money away, and then get them into a much better product without having to go and bend themselves over like that.
Yeah.
You know what I mean? But again, like these schemes, they're out there, and as much as it looks good and it can get into the market, like there is a question, is that actually the best thing for you to do? So, but yeah, there's the few.
So we've talked about a few different creative ways to get in, but what are some other options that people aren't considering? For example, location.
Yep. Yeah. So yeah, we spoke about you and your situation. So increasing income, lowering expenses. We spoke about how to actually buy the property. The third world, which we didn't speak about, was now the type of property. And this really now comes to a conversation of compromising.
Yeah.
Right? Because, and keep in mind, our research team through Mark, I was having a good chat to him last week, right? And he's been in the industry for 30 plus years, very, very experienced.
Mm-hmm.
And, I'll sort of explain to him, this is what we consider like an A-class property. This is the ideal we want for our clients every day.
Yeah.
This is a B-class property. Still pretty good. Still buy it, but we prefer A's.
Yep.
And then you got C-class properties, which is what the average market is. And that's that. Let's just say we just buy and stack up C-class, that's where you're going to get the median growth rates, the median performance. You get the averages of all of it.
Yeah.
And keep in mind, you're still going to become extraordinarily wealthy doing that.
Yeah.
So it's not actually a fucking problem. It's actually a really good thing you'll be doing. But really, when we've got a client who comes to us, and let's just say, for example, the client's got requirement A, B, C, and D. Like obviously, we want to try and get an A-class property. Mm-hmm. But when we've got requirement A, B, C, and D, it's just not realistic. He's either got a really tight budget, he's either got certain requirements in terms of work or location or house configuration. Like it has to be. I've got 3 kids. We have to have 3 rooms. Get what I'm saying? So when those situations come in, like the reality is, we have to compromise because there's no such thing as this doesn't actually exist in this market because your budget's $400,000 and the market's at double.
Yeah.
You know what I'm saying? So that's then where we've then got to start compromising in, cool, what does a B class property look like with these parameters?
Yeah.
What does a C class look like?
Yeah.
And so we've got to be like, what some people do, and this is where I see people go wrong. What some people do is they'll say, cool, well, these are my requirements. This is what I want. I know what I want. And now I'm going to wait until this happens.
Yeah.
All right. And I have seen people wait.
And wait.
6 months.
And wait.
A year. It's now been 2 years.
Yeah.
And the problem is the market's moving further and further away.
Yeah.
Because we're not talking about, and I've got the client I've been thinking about in this exact example. We were looking at properties at the beginning at 450.
Yeah.
Those same properties today are 750.
Yeah.
And unfortunately, she will never get into the market now. Because her cap, she can only borrow 500 grand. And so, it's one of those ones where waiting for the market to crash or waiting for the market to correct or waiting for the market to come down will never happen. And my evidence for that is, when was the last time the market crashed? And that's a trick question because it's never crashed. And it's never crashed because we have way too much population growth. We've got not enough housing supply.
It has a moment. I wouldn't it has a moment. That's how I would describe it in Australia. Is we have a moment. It's not like boom, crash, like bottom of the market. It's not like we have a moment where it goes, oh, hang on, we'll just float down here for a minute and then we're back.
And then back up, yeah. And I mean, even during like our last downturn from 2012 to 2018 here in Perth. Mm-hmm. I mean, from the where it was in 2012 to where it was in 2017 was the same point.
Yeah.
But the median dropped around 15% between those A and B points over a 5-year period, right? 15% is nothing.
Yeah.
Right? Keeping context, we grew at like 12% last year. So we've grown more in 1 year than the entire 5-year slump was. So like now keep on, when I say that, like let's say there's 20,000 transactions in Perth that 1 year where it's gone down 15%. Most of them would have gone down a little bit. There'll be a big chunk that have gone down 15. There'll be still would have grown. We're still using like the median's a bit of a funny way to put things. It's sort of the middle number of everything that's going on, but it's a good indication. It gives you an idea of the overall.
It's basically like that saying. It says, it's not timing the market, it's time in the market. Is that, at the end of the day, it doesn't really matter when you get in. Yeah, great if you get a bargain, but at the end of the day, like property's going to continue to increase. It'll have its moments.
Exactly.
But it'll continue to increase. And so, I suppose like for first investors or whatever, like I think sometimes the idea is that like, they have, like you're saying, their A property, their B property or C property.
Yep.
I think, and even, a lot of people are looking through the lens of, I'm buying this as a home. And, a lot of the time we'll have conversations over and over with clients about actually you're probably better off to buy an investment property first as opposed to buying your home, because long-term it's going to set you up far better. But I suppose for some people it's getting over that hump of like, oh, actually maybe I should be buying in a different state, or, or getting over that hump of like, oh, actually I'm not buying a home. Like, I think that's a big hurdle for
sure.
some kind of first time.
Yeah, definitely. And
purchases.
Look, this comes back down to the mindset thing again. Look, we've been conditioned as a society that buying a home is the symbol of prosperity. Yeah. And it couldn't be further from the truth. Mm. I don't own a home that I live in. I rent. I'll probably rent forever, to be completely honest with you. Even today, because the house across the road from us just sold like last week. Yeah. If I was to buy that, I'd be spending $5,000 a week in interest.
I know. I literally had this conversation with one of the school mums.
It's insane.
And she's like, oh, so, you're going to buy in our area, kind of, because our lease came up and we ended up renewing it. But there was a moment where we're like, oh, maybe we're not going to be able to renew. And anyway, and she's like, oh, so you're going to buy? And I'm like, no. I was like, it's double, like minimum double to, even if we, get a different lease at a higher, paying more, we're still going to be saving money. Yeah, you don't have the same necessarily security in some ways, but in other ways, there's so many other perks. So, but I just am like, no way am I buying in this area. Yeah. Like, no way.
It's insane. But like, just notice that people are still convinced that's the best thing to do.
Yeah.
And again, it's unfortunate when we listen to the media, the schools, the government, the rest of the world.
Yeah.
The rest of the world does not want you breaking out of the system.
No.
They do not want you. And look, to be fair, like there is, I think part of that is your friends are, and I'm saying this, I'm not saying your friends directly. This is very general thing, right? But like my experience is most people want to keep you safe.
Yeah.
And they want you, they want to protect you. They want you to be, they don't want you to get hurt. They don't want you to be seen as risking something and then lose things. They want to keep you safe. But what you've also got to realize as the person who's in your own, this is your life.
Yeah.
Like that also means that in those conversations, they're also going to try and bring you down.
Yeah.
The more you resist that fact, the more you suffer.
Yeah.
Yeah. Get used to it.
Yeah. I'm used to the fact that people aren't necessarily going to understand why I'm renting.
Yeah.
Like, I'm happy. Like, I'm like, yeah, probably the next purchase will be another investment property.
Yeah.
Like, in reality, personally, the only time I see us buying again is like if we were to like down the track.
The dream. Yeah.
The dream home.
Yeah.
Like where we've designed it how we want it, like we've not got a mortgage on it, like all that kind of stuff.
Yeah.
But that's a little way away yet.
I hear.
Yeah.
I hear.
Yeah.
You and me both.
So what could a messy first purchase look like?
Good call. Well, there's a number of things that can go wrong. I mean, look, I guess the first thing I'd say, when we think about investing, if it was easy, everyone would do it. But notice how not many people statistically actually succeed.
Yeah.
And there is something to say for the fact that it is difficult, right? And shit's going to happen. Shit's going to pop up, right? And it can be anything from, and I'll give you some examples of what we've dealt with just this week. Sellers, let's just say, what's the word? Sellers are imploding on themselves, right? In terms of the requirement, this, that, and the other, and changing their mind and blah, 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 blah. That can always cause friction, right? When it comes to approaching the bank. I mean, things like, for example, bank valuations are really much of a problem going back, sort of 5 years ago, pre-COVID. And again, because, we're in this kind of downturn, we've been in this sort of downturn, this slump over the last couple of years. The amount it costs to actually build a home is way more than what it costs to buy an established property. Yeah. And so every house was getting low valuations. Every new, and this is clients building the dream. First time buyers trying to get the grants, you name it. That can be a hurdle. The amount of times that we've had to change banks on clients.
Yeah.
In other words, if you want to be a proper investor, get used to changing banks at least once a year.
Yeah.
All right. Buckle up and get used to it.
Yeah.
All right. It's part of the game. When it comes to tenants, right, and finding tenants and managing tenants, that can be a nightmare.
Yeah.
One of the probably the major pitfall that we see when it comes to clients is really, like, even when it comes to using services like us, right? Like, using a service like us is really designed for people who don't really know what they're doing. So they need the professional guidance. They've got no time to do it themselves. They're just time poor. So they're either on site, they're busy professionals, they've got, their own business they're running and they can't be bothered doing this. And then people who don't necessarily have the resources. And I'm not saying necessarily money, but more so the bandwidth, the attention, the energy, the mindset. Like, hey, I can't, I'm the sort of person where there are certain things that I just refuse to do in my life because it just takes way too much resources.
Yeah.
And I know if I spend time doing that, I'm going to be burning things elsewhere. All right. So it's just, I've made a call. I'm not mowing my own lawn, for example.
Yeah.
Or cleaning my own house. So that's an example. Like, that's who really our clients are. All right. Yeah. But as a part of that, what some clients then say is like, cool, well, you guys will just make this whole thing easy then. Well, no, it's still hard. Like, it still sucks. There's still the same, we've still got to jump through the exact same hoops everyone else does. We're just facilitating it for you. But you've still got to be prepared that, hey, there's going to be hurdles.
Yeah. And
when that hurdle comes up, instead of stopping running and thinking, fuck, there's a hurdle here, and then just getting mad at the fact that there's a hurdle, it's no, we jump the hurdle, we keep running, and you have a smile on your face when you do it.
Yeah.
That's the mindset you need.
Yeah.
And again, it's this is just obviously coming from working at scale over hundreds of people over the last decade. Like, it's, some people can't take that. They can't handle that.
Yeah.
Because the stress of their own life, the stress and pressure of their own world that they're dealing with, now dealing with this, it's just too much. We're trying to ease the burden, but you're still walking the same path.
Yeah. I think though we do. I think probably what you've missed there though is we do make the process simpler.
Oh yeah,
because
simple
through the expertise that we provide,
for sure.
It definitely streamlines a lot more for clients. Whereas like you said, there's still going to be the hurdles. There's still going to be
same hurdles.
That there's still people involved.
Yep. Yeah.
When people are involved, there's always going to be something.
Yeah.
So cool. So if we kind of like go back to that initial thing of, you know, doom and gloom but really we're in a boom.
Yep.
Like we're in a boom. It's a good thing.
Yeah.
Like, well, until it crashes. But it won't crash, as you said. Just have a moment.
Correct. Yeah.
But, you know, just reframing that doom and gloom, what fears do people have that disappear when you actually kind of run the numbers and actually kind of just show them that kind of data and that step-by-step process?
Yeah. For the most part, like it is the fear of the unknown is probably one of the worst things, right? And what I mean when I say that, obviously, mentioned my daughter had a little issue the other week, went to hospital. The fact that they couldn't actually tell us what happened is probably the hardest part.
Oh, 100%.
You know what I mean? And because there's just no sort of closure there, right? And so, for the most part, as soon as the clients actually understand what we're actually trying to do with the property, right? They understand the mechanics, they understand the reasoning why, then we've got the numbers to back it up. Just putting that together for them, 9 times out of 10, like you can see their stress just, okay, that makes sense. Like, I get why we're doing this now.
Yeah.
Again, like I said, a lot of people, they just buy a house because their friends buy a house. Or they've just bought an investment because their uncle told them to.
Yeah.
You know, they don't really understand what we're actually trying to achieve. They don't know that, and what I mean when I say that, I'll give you a real life example. Client came to me a couple of years ago and he's like, oh, you know, Corey, this whole property investment thing doesn't work because, you know, I bought this house and I'm just losing money every week. And it's like, cool, well, let's have a look. Let's go through it. Went through it all, blah, blah, blah. Went through the values and rents and went through the normal kind of cash flow schedule that I normally go through. And I was like, look, to be honest, this looks like a normal property. What are you not happy with? It's like, oh, you see that figure down there? See how it's negative? I'm pissed off that it's negative and it's still negative.
Yeah.
And it's like, look, I get it, you know. The problem is though, he wasn't really aware of how the market actually works. And, you know, he was under the assumption that, you know, you're going to buy an investment property, you're going to put a tenant into it. It's going to be positively cash flow from day one. That tenant's going to then pay the house off. Then you're going to live off the cash flow in the future and you're going to, you know, ride off into the sunset.
Yeah.
That's not how it works. The only reason why we buy residential real estate is for growth.
Yeah.
We want to buy it 5 years ago for 500 grand, it's worth $1 million a day and do that 10 times.
Yeah.
The only reason why we put tenants into that house is to offset the cost of ownership. That's it. It's not to pay the house off. Yeah. It's so that you can own that land for as cheaply as possible. Yeah. All right? Now, what starts to happen over time is as that mortgage comes down, as the rent starts to increase, it becomes more and more positive. And then, yes, that's then when the tenant starts paying it off for you. All right? But again, like he wasn't really in the world of like what he's actually trying to get out of this. He just thought, fuck, I'm losing money, therefore this is bad. Yeah, I'm losing money, therefore equals bad. No.
Yeah.
Then when I showed him how much money he's made when he purchased it, what it was worth, I showed him what he's lost year on year, stacked it up. It's like, dude, well, you've made 350 odd grand. It's only cost you $7 grand a year.
He's like, oh.
4 years later, you've made that and it's cost you that. That's a pretty bloody good investment if you ask me. But when he saw it and he saw the full picture, like you could just say, holy shit, this makes sense.
Yeah.
Like, and just the awareness of the mechanics. And look, I'll be honest, I'm at a point now. I think it is absolutely insane. Everyone's not running around right now trying to buy as many houses as they can.
Yeah.
It's like, but I know the mechanics so well that to me, it is actually mind boggling that not everyone's doing this. And this is why, there is an argument. I'm technically standing in front of a roof right now. I'm yelling this out to the world.
Yeah.
But I'm doing it for a freaking reason because it just freaking makes sense.
Yeah.
And not only does it make sense, this is
because you know the data, you understand it. You
correct.
Understand.
It's a no-brainer, you know, and really the idea is...
It's not like a risk. It's a calculated decision based on
correct.
The data that you're seeing in front of you.
Yeah.
Yeah.
Whereas most people, the risk is the unknown.
Yeah.
And that is fundamentally a risk. But once you sort of see it and you understand really what you're trying to do, the idea is it just becomes a no-brainer.
I think probably one of the biggest things, kind of the theme that I've felt flowing through this is that essentially like education, like knowledge is power. Like that's where the fear is reduced, is in the education, in the knowing what's actually going on.
And to that point, you know, I'm standing here today confidently saying that not only is the market not changed, anyone can do this.
Yeah.
Sure, not everyone can do it, but anyone can do it.
Yeah.
You know, just like not everyone leaving high school tomorrow can become a pool cleaner, because we still need doctors, right?
Yeah.
But anyone can become a pool cleaner.
Yeah.
Anyone can do this stuff. And it doesn't, you don't have to be rich. You don't have to be, you know, earning, you know, 6-7 figures. 6, 7, 5. Did that thing.
6, 7. I don't know why I didn't pick it up straight away.
I don't, honestly, that beat my brain last year. Anyway. But the point, like, the people, you don't have to be rich to get into this.
Yeah.
You don't have to be rich. Like,
no.
Like,
yeah.
I wasn't.
Yeah.
And, you know, we've got clients today, they are absolutely not rich and they are still getting to the market and still winning, you know, and really it's being in the market, to your point. That's what's going to make you rich.
Cool. So my last question to you is, if you did have to start again today on an average income, what would you do? I'd
join OnlyFans. No, I wouldn't. I'm kidding. So look,
a tote page.
For watches, OnlyFans for watches. No. So look, in all seriousness, the first thing that I would do, and look, I've mentioned this to you before. Like, I've got like an 8-step process.
Yeah.
In terms of, I have the idea of writing a book at some point, and it's going to be 8 steps to wealth.
You should.
Right. These are the 8 steps, and these are still the same 8 steps that, I personally believe it's tried and tested and it works with every single person I've put through these 8 steps.
Yeah.
The first thing is mindset.
Yeah.
All right. You've got to understand your why. You've got to understand this is going to be hard. You've got to understand the majority of the world is trying to hold you down and not allow you to do this, which means that you now need to start doing the things that most people aren't willing to do.
Yeah.
Delay gratification, sacrifice shit. Like there is a lot of things that you need to do to get your mindset right before you even start. Secondly, from there, what I would then focus on is how can I get the biggest possible income? All right. I went to uni, hated uni. When I really understood about how the world really works, and when I understood about how, you know, investing works, and, you know, the fact that most people are unfortunately resigned to work in a job they hate forever, and they're doing it because they think that they're helping the planet, I think is one of the biggest cons that's been put over society's eyes. So I would try and go and earn the most amount of money I could possibly earn. All right. I don't give a shit if I was cleaning the street. I don't care if I was cleaning toilets. Doesn't matter. It's irrelevant. The biggest income I can get my hands on.
Yeah.
Now, in order to do that without qualifications, the reality is, guys, you either need to get into business, or you need to, and when I say get into business, like provide some kind of value to people and do it at scale, or get really good at selling shit. All right, because sales commissions are really big for entry level. All right, so earn the biggest income I can get my hands on. Then from there, I want to look at a budget and I want to reduce my expenses, and I would want to be focused on having really sharp expenses, having a really big income, and build surplus. Once I've built that surplus up, then I want to put that money to work. Now, what I would be starting with is the most entry level types of investments. Like I said, for ETFs, there's a bunch of different platforms you can go and put dollars on. You know, and you can start investing in shares from with dollars. Having said that, the share market isn't going to be as lucrative because of leverage for most people. So I'm only investing in shares purely to build enough money to get my first deposit.
Yeah.
Then I would go and get my first house. From that point, again, like I said to you at the beginning, you always want to be doing one or two things with your money. So once I've bought that first house, I would either want to be focused on building more equity or more of a deposit so I can buy the second house as quickly as I can. Or I'd be focused on driving down that debt.
Yeah.
Now, the good thing is when you got one house, 2 birds with one stone, just drive down the debt.
Yeah.
All right. Because that equity that you're going to pull out is your next deposit anyway. So the 2 birds with one stone. All right. So I'd be focused on driving down that debt. Within 12 months, I probably want to be in a position where I can use the equity from the growth and what I've drive down to buy my next house as the second. All right, and then do that, replicate that year on year for as many years as I can. Now, what starts to happen over time is you get to a point where you're starting to max out in servicing. And what that means is you got too many assets, too much debt, not enough income, where that's now where I would consider the foundation of your strategy is now laid. Now we want to think about how do we put this bad boy on steroids. All right. So what I would be then doing, and this is what I've been doing over the last couple of years, because I've been quite limited by my borrowing capacity with new businesses and, negative incomes and all that sort of stuff. I will be starting to use the equity of each of these houses to then reinvest in cash flow assets. Again, remember, Australian residential property is a growth asset.
Yeah.
You don't buy it to live off. Because even once that house is, their mortgage is paid off, you're paying council rates, water rates, insurance, maintenance, and managing forever. Your $20,000 a year is going to be more like 12 after those.
Yeah.
That's like a 2% return. That's a terrible return if you're looking for cash flow.
Yeah.
All right. Property is a growth mechanic. I'd be pulling out every dollar of equity I can at all time. And what I mean when I say that, even now, every year, I knock on Aaron's door. Hey man, how much equity can I pull out?
Yeah.
I pull it all out. Because if it's sitting in my portfolio, as far as I'm concerned, that's lazy money doing nothing.
Yeah.
I always want to liquidate as much of my equity as I can and then reinvest in other assets that are cash flow assets.
Yeah.
I'd be buying businesses. I'd be investing in, one of the things we've got at the moment are like international properties. Like I'd be buying villas overseas, like in Bali, where you can buy a villa for 400 grand, bring in 90 grand your positive cash flow.
Yeah,
exactly. So those those are really good examples of cash flow properties.
Yeah.
But again, house number one buys one kind of a cash flow asset. House number two will buy the next one in a couple of years. Next, third, so on and so forth. All of a sudden, I've now got 4 or 5 different cash flow assets that have replaced my income. This is then when I use my overall strategy to now start getting to really big projects.
Yeah.
This is where property development comes in. This is where buying, let's just say, medium-sized enterprises and being more of that kind of angel/venture capitalist when it comes to those bigger sort of projects. Yeah, as an example, if I've got any of my really trusted friends who I think would succeed, and they want to start a business, I'd be an investor in those. And I would make sure that I release some capital, 200, 300, 400 grand, and be able to invest in those with them and help them. But the point is, it all starts with that first property. And even just from what I've said, and I'm saying this because I've just done this, it starts off with 1, turns into 2, turns into 4, turns into 6. Then those properties turn into other cash flow assets that starts turning into bigger projects. And all of a sudden, most of my wealth today is coming from business.
Yeah.
And other businesses not outside of this one. So again, I'm not reliant on just my my Perth-based properties.
Yeah.
I'm not just reliant on just my properties.
Yeah.
It's my entire system that's building my wealth, not just an asset.
Yeah.
You know what I mean?
Yeah.
That's what I do.
Yeah. That is absolute gold there. You just heard from Corey Jones, his strategy around generating wealth long term. And if you did not hear that, you need to rewind and go and listen to that again, because get a pen and paper, because it's absolutely gold. So yeah, I think we've covered a lot of ground today. And I think, one thing I really want people to take away from this episode is that getting started doesn't require perfection. You just got to start. And I think, what we spoke about, a big part of that is your mindset, and then, putting to work what you do have, and, looking at what is possible. So, if you're in that position and you kind of looking at ways to get started, feel free to reach out to our team. We're always here to help. But from us today, thanks for listening. And we hope that we have helped anyone who's feeling a bit overwhelmed, give you some solutions as to how you can get started. Anyway, have a great one.
Hell yeah, Katie.